Hello, everybody. Good morning. And today we are talking about covered call ETFs, in particular, like the JP Morgan Equity Premium Income ETF that you see in front of you. Now, the way these covered call ETFs work is that you basically get paid for owning these on a monthly basis. And if you're new to covered call ETFs, if you don't know what covered calls are a way for you to earn income against stock you own. For example, you could own 100 shares of XYZ stock and sell a call option to make income on your shares of stock. So when you combine that with dividends and covered calls, you can earn income on top of income, basically. There's people who do it, the double income strategy. I've talked about it on the channel before. But with covered calls, it's not like dividends where the company's paying you. You're actually going out and writing a covered call based upon shares that you own. Well, it's the same concept with these ETFs, except it's done on an index or it's done on something along those lines, some type of maybe diversified portfolio of stocks that they have. But all of these ETFs, and this is just one example. For example, we can look at QYLD, the Global X NASDAQ 100 covered call ETF. I just discussed this one on the channel recently. Amplify CWP Enhanced Dividend Income ETF. $40 was the last traded price, it looks like. And at the last year it's up, it looks like $1.95 or 5.10%. So one thing you'll notice with these, if you're looking at the time frame that I have on these, look at the returns. Now, the market itself over the last year, S&P 500 is still technically in a bull market. We're up, right? And so even though there's been a correction, we're still up over the last year is what I'm saying. I think like 8 or 10%. So we're still doing okay on the S&P 500. But if you look at these returns, they're not quite keeping up with the S&P 500. And so when we're looking at a question such as why are covered call ETFs bad or are they bad? The AI overview comes up. It says covered call ETFs are not inherently bad, but they have limitations and potential downsides compared to traditional index ETFs, especially during strong bull markets. So they basically seek to sell call options against stock they own in a portfolio, to keep it simple. And it leads to lower overall returns if the market rises quickly. And why is that? Because covered call income is capped at a certain level, right? So whatever the strike price is of the option you choose. Now, let's say the stock's at $50 a share. You sell a call option at 55, and anything above $55 a share, if the stock goes to 75, you just missed out on $20 per share profit on each one of your shares. Now, each options contract on a covered call is going to be 100 shares of stock. So 100 shares of stock times $20 a share, that's $2,000 potentially of missed profit. So that's lower returns in a rapidly rising market. Now in a neutral or bearish market, covered calls are good. And these ETFs in a neutral market especially can probably generate more income. And they can probably do so while maintaining the share price and of the ETF, the net asset value. But what happens is, if you look at the longer term, for example, QYLD, honestly, for being out as long as it has been, it's down 32%, $25 a share. This thing has been paying consistent monthly dividends nonstop. If you look at the dividend yield, I've seen this thing around 10 to 12%. And as you can see, they've been paying out those monthly distributions consistently. They never miss on the distributions. And this is the thing, when you're looking at something like this, where you can get paid on a monthly basis, these things are great for income. But what's the long-term impact on your capital? You are down, if you held this ETF, let's say even since 2015, you're still down, right? From 22 down to 17. Now you could be reinvesting dividends, but as you can see, your capital is going down. Now what happens if we have another large market crash? You see 2020, for example, it bounced down to $18 and then came back up to 23, but it's never recovered since then. So if there's another big market downturn, yes, your downside might be more protected with something like this. In fact, I think it goes over downside protection. During market downturns, the premiums earned from selling covered call options can help cushion some losses. And that's because you're getting paid out these dividends, or not so dividends through the ETF. right? So you're getting paid out dividends through the ETF technically on a monthly basis. But the way these ETFs are doing the strategy, they're selling these options, which is actually the return they're giving you through those monthly dividends, right? And so that is going to help cushion those losses if the ETF value or the net asset value of the portfolio, whatever they're selling it against, goes down in value. So keep that in mind. So they also have lower volatility than only long ETFs. So covered calls can kind of act as a hedge if you think about it, and you can earn some income against your position, and you can reinvest that money. You can do whatever you want with it, but basically that's how it works. And so if we're looking at the longer term returns of something like this, now this one's interesting because over the last 5 years, this is a covered call ETF, keep in mind, they're doing something right. So you not only have a decent amount of share price appreciation, but you also have, going from $22 to $40 a share. But also, if you look at the dividends they're paying out, you'll see a similar pattern here. On a monthly basis, about 5% yield, $2 annual dividend, they are paying out a good amount of dividends every single month. It's coming through, and you are getting paid a decent amount in dividends. And, a 5% yield. Now, QYLD is better, but look at the longer term return. You're getting, the max 61%, not bad since 2016. Not bad at all, guys. 61%, and you're getting a nice 5% yield. So they're doing something right over here with Devo. So I think the answer really, when it comes to ETFs like this, and we'll go over some more, is that it really depends. What are you looking for? I don't think these ETFs are bad at all. I don't think when you're looking at, some people will say because you're not getting that return, the share price appreciation because your upside is capped, that it's very bad. And therefore, what's the point of these covered call ETFs? Because you're just going to earn income, but it's not really going to make up for the total return, etc. You might underperform the S&P 500 even with the dividends. And then if you're withdrawing the dividends, your return is actually going to be lower because you're not putting more money back into it. So there's a lot of things to consider. But if you're looking for income, like I said, if you are looking for income, maybe you're a retiree and you don't care. You're thinking 10 or 20 years, you want to put a portfolio together for retirement, and you want that, let's just say, to last 20 years or 15 years or whatever it is. You can put that portfolio into work, into some of these ETFs, and have that regular income with lower volatility. And if you look at a couple more of these here, let's take a look at, there's another one I had pulled up here. I think it was JEPI, probably JEPQ is another one. We can go over JEPQ. Yeah, here's JEPI dividends. So this one I've talked about on the channel as well. If you look at the 6.9% yield, now look at the total return of JEPI. So this one also, over the long term, has not done bad. Not up a huge amount in the last 5 years, but up 13%. At least we're not losing money on the principal. JEPQ also, up 7%. But JEPQ has a larger dividend, from my understanding. Let's see what the yield is on this one. Yeah, so it's 11.25%. So you get less upside. You're not losing money on the principal, but you're getting an 11% yield versus a 6 or 7%. So $5.70 in annual dividends. I mean, I think what we've seen with these ETFs is that if they're worth it or not, or if they're good enough, or too good to be true, whatever it is, people are saying about these covered call ETFs. I've heard a lot of people, talking bad things about them, some good, some bad. But I think there's a lot of factors to consider. I personally think they can be used as a tool in a portfolio, and maybe even as a retirement portfolio itself, and maybe a good portion of one's portfolio. If they're diversifying into different ETFs, we have a large enough sample size, I think, with these ETFs now. They've been out for a long time to where we're seeing that, hey, there is some upside potential in some of these, depending on the strategy and what they're doing. Like QYLD was losing money, but Devo, JEPI, and JEPQ are all doing good. But also, not just the potential share price appreciation, but the fact that you're getting those consistent monthly payments, I think, if you're in retirement and you want something where, yes, the dividends are variable as we see every month because it's based upon how much premium they're receiving. So you're not going to get like super, but as you can see, we're in the same range for all of these dividends. If you look at the range we're paying out with all these ETFs, you're getting a similar monthly variable amount that, yes, is going to be different every month. You can put it in a spreadsheet and track it if you want. But the point is you're still getting those dividends no matter what. And so if you think about building $1,000 per month, $2,000 per month income stream from something that pays 11.25%, that extra yield, even 5-7%, because some dividend stocks only yield 2 or 3%, right? So that initial dividend yield does help out quite tremendously, actually. And that's if you're looking for that immediate income. So if you put in like $100,000 into some of these and you want to get a consistent income stream, and you could be looking, if you're putting in $100,000, if you had an 11% yield with some of these, you could be looking at $11,000 or almost $1,000 a month right there. So that just shows you how far these can stretch and what type of yields you can look at. But I don't want to speak all positive about these because with that in mind, there's always risk. And one of the risks is that you could see share price underperformance, and we've seen that relative to the S&P 500, the NASDAQ. These ETFs do underperform. They do, in fact, underperform. Yeah, we're up 61%. Over the last 5 years, we're up 80%, but the S&P 500 is up more. It's over 100% in the last 5 years, right? In fact, we can look that up right now, and you're seeing underperformance, but the dividends are kind of making up for it, right? So if you look at the long-term performance, though, it's just, if you look at also capital decline, like with QYLD, over the last 5 years, we're up 7% with that one. But then you look at a case like QYLD, which is actually going to be down, how much? 7% in the last 5 years. Not a crazy amount, but the S&P 500 is up 140%, keep in mind. So would it be better just to put it into an index fund? How much in dividends are you making? Are you reinvesting the dividends? But then again, it also depends on your risk tolerance investing goals. Are you speaking with a financial advisor? Are you building a portfolio? Could these actually be put to use in retirement? That's the real question. I think people are doing it already. We've seen. Let me know if you're considering doing this or if you've already done this in retirement. I'd love to hear from you. But what do you guys think of covered call ETFs? Are they worth it? Are they, too good to be true? Are they overhyped? Is it just a marketing tool by a lot of these, Wall Street firms that are creating ETFs? I'd love to hear your guys' thoughts in the comments down below. Thank you so much for watching, and we will see you in the next one. Take care.